Hello and welcome. Global markets have remained volatile this month, as we have seen throughout this year. At the time of recording, global equities are generally slightly higher than where they started July, though any rebound remains pretty fragile, and the short-term monthly picture can change quite abruptly from one day to the next, which is why our focus remains on the long term. On the fixed income side, the government bonds have actually been even more volatile lately than equities compared to their own history. The US 10-year yield, for example, have fluctuated sharply between 2.9% to 3.1% during July, and similarly the UK 10-year yields have fluctuated between 2% to 2.2%, but without ultimately finding a clear direction. So, what's really causing all this uncertainty? On the macroeconomic front, we've seen a lot of fresh data come across our desk, among the most notable being the June US Consumer Price Index, the CPI, released on Wednesday, the 13th of July. The figure came out at 9.1%, which was slightly higher than the global consensus, which was 8.8%. It reinforced the view that the US Federal Reserve will remain aggressive in normalizing its policy rate, and that another increase of 75 basis points or even higher at the next policy meeting is likely. It's worth noticing that well-respected business surveys data, like the Purchasing Manager Index, the PMI, which is an insight into the mood of business leaders, have remained robust in the US and in Europe. This is backed up by other measures like retail sales, housing data, and unemployment rates, which have also been supportive of a positive economic situation. On our side, we've made some changes to our fully managed portfolios to better position ourselves for the months ahead. We removed a small excess equity allocation, benefiting from a slightly more stable period for equities. While we had let this equity allocation drift lower during the year as markets fell, we made a further reduction by selling a small share of US and UK holdings. Within higher risk fully managed portfolios, we also added a small allocation to global energy stocks following a pullback in prices this summer. This was financed by halving our allocation to US financial stocks. So in summary, we are balancing three main risks we see in the global economy this year. Firstly, inflation has proven itself to be more persistent than forecasted at the beginning of the year, forcing a much faster intervention from central banks than what was anticipated just a few weeks ago. Secondly, the conflict in Ukraine is showing really little sign of easing and may continue for an extended period of time, posing enormous challenges to commodity supply, among other risks, and in particular for Europe. And lastly, the strong global demand following the reopening of the economy post-COVID might start to be challenged by the speed of rate increase from the central banks and the amount that they increase by. Therefore, our current positioning for now is to have neutral equity exposure versus our long-term target, and it's really balancing uncertainties that lie ahead with an equity market that is already trading much cheaper than earlier this year. We are also maintaining our underweight to bonds, this despite us starting to buy back into the asset class tactically in June during extreme price movements. We also remain overweight the dollar, which has proven to be the best performing currency so far this year. And there will be no let-up in the next few weeks with the all-important earnings season in the US culminating at the end of July, which will give a corporate perspective on the current environment. There may also be much activity from central banks, with potential rate increase from the US Federal Reserve, the Bank of England, and the European Central Bank, and all within a one-month period, and it's something we haven't seen since 2007. You can read more about the recent changes we've made to the portfolios in a recent post on the Nutmeg section of our website and the blog section of the Nutmeg app, which is called How We've Rebalanced Our Portfolio for the Months Ahead. As usual, thanks for watching, and if you have further questions, feel free to contact us directly.